Okay, and I hope Saith and William get their book quickly. We were going to do the journal entries for a service industry, but you've got to do problem 34. Now, I want to see that problem from each one of you. Jessica and Alexandra can have that by Thursday, and William can have it as soon as he gets his book. Problem 34 is a must. Now, journal entries is a must. We went over a few. Problem 44, I think we went over it, but if we didn't, it is a must.
So 31, 44?
Yes, 34, 34. I know we did 49. All right, I want you to do 52. Number 52. Now, the only thing we're going to look at this morning in this chapter are those journal entries for a service business. Now, those will be on page 53. And I just more or less want to run through those entries with you pretty quick. Let me see if I've got. Oh, that's Outlook. I showed it one Outlook. I wanted Word. That don't look like it. I thought I brought it up, or had it brought up. Gosh. Come in, Faith. How are you today?
Pretty good.
We're going to look at a solution. This says, well, this is cost accounting. I started bringing up principles again. I want to take you down to exercise problem, whatever, 35. Faith, has your book come in yet?
It did, but I left it at my house.
Huh?
It came in, but I left it at my house.
I'll just let
Yeah.
get the assignments from Alexander or somebody before you leave. There's 2 or 3 problems that are a must in this chapter. We'll get back to them, but not today. All right, now 35. If you don't have your book, I'll read these to you. This is a service business. This is a CPA firm. Prepare journal entries. All right, we used 35,000 of previous purchase supplies on an audit program. Okay, I just wanted you to see these journal entries for service business. This allow thing keeps coming up. I wish it'd go away. But here's the journal entry for that: work in process and credit supplies. We can use cost concepts for a service business. Now, back when I was teaching at Buckhannon County, Joel Spokeless, my co, and and you can use some cost concepts for mining coke. But Joe Smokeless also had a coke plant. They made coke. There's all kinds of coke. All right? But this was coke they made from coal that goes in to IRON to make steel. And they use cost accounting concepts. All right? I knew the cost accounting to work for them, and we talked about it. All right? But this is, of course, the service business. We paid $8,000 of partner travel expenses for conferences. All right? That would go into this travel expense debit and credit cash. Then we received $6,500 depreciation on laptops. Well, we know that's would be overhead. Debit fixed, overhead fixed because it's probably straight line, or if you were using double declining balance, sum of your digit or units, it wouldn't be fixed, it'd be variable. Straight line depreciation is fixed. All right, recorded $1,800,000 depreciation on the main building located in downtown New York. That says 65% of the space is used for house the audit personnel. All right, so let's look at that. Credit accumulated depreciation, and then what is that? Wait a minute, what percent is that? $1,800,000 of annual depreciation. But here's not $1,800,000, is it? Am I down too far? 65% of the space is used for the audit program. I'm missing something here. Where does this come from? You that have a book, Jessica and Alexandra. Where are they getting $150,000? I don't see it.
All I can think of is that 65%, but
Well, 65% of $1,800,000 is definitely more than $150,000.
I have no idea where they got that from.
All right. Well, there's a misprint or something. But the depreciation is $150,000. They'll give you a percent for auditing is $97,000, fixed overhead control, and depreciation administrative expenses $52,000. Then you have audit salaries, debit work in process, and credit salaries payable. Now, my daughter worked for one of the big six accounting firms at the time out in St. Louis. And she had to travel a lot. She traveled to 39 states, 100 and some cities. And she pretty much kept her suitcase packed and her laptop to go with her. But she found it real interesting. She got to travel. She got to audit Anheuser-Busch Beer Company. And she audited nursing homes. And she talked about how those old men tried to flirt with her. She audited construction company. She had to go out on site and make sure the bulldozers' IDs matched the paperwork. She audited a construction company that had big containers of sand and cement, sand and whatever other materials goes into making concrete.
I think I figured out where the 150,000
Yeah,
came
where'd that come from?
Where it's for annual depreciation is just asking for 1 month, so divided by
How
12.
about that? Divide $1,800,000 by 12. Divide $1,800,000 by 12.
It's like 8% per month.
Yeah. Yeah, a fraction. But divide $1,800,000 by 12, see what you get. So that gives 150.
Yeah. Yeah.
All right, multiply that 150 by 67.
67. It's 65%.
65%, okay. Now what have you got?
97,500.
All right, good observation there, Alexandra. I'm glad we got Curious Mind in here. I was about ready to fly over it without reading it well. I'll have to help Jessica be out. I'm sleeping, she's sick. Okay, look at these other entries. Accrued remaining audit staff salaries, 257. Should be the same type of entry. And paid credit card charges for travel costs for client engagements. That's also work in process and credit cash. See, what you're doing for this audit, like my daughter, her travel was overhead. Her motel and stay there, her salary was work in process on that audit. Now, one thing I didn't agree with my daughter on, they pick the auditing firm, they pick a company. They say it is a nursing home. And they say you should be able to audit accounts receivable in that nursing home in 7 hours. Well, the auditors that worked for Cooper Lyburn, which was one of the big six at the time, was probably one of the big four. Remember, Enron brought one down. But if it took 10 hours, she'd work 10 hours on it and only report 7. They promoted lying. Because if she reported 10 hours, they thought she was no good. The average is 7, she took 10. And that's why all auditors lied to their big companies. All right, and moving on down, paid credit card charges for travel, then 1 month's prepaid insurance and property tax. These are still going into work in process or overhead of some nature. The insurance expense, some of it was administrative, some of it was factory. All right. Variable overhead, this was indirect wages of 1,400, I don't know, 3,400. Accrued 3,400 of office assistant wages. The office assistant works only for the audit partners. Okay, so that makes her indirect labor. And it's variable. Paid all accrued salaries and wages. We know that's debit salaries payable and credit cash. But I just wanted you to see some going ons here with a service business that you could apply it. And I don't know what this question was, but the labor, the two labors together, and the entries, you could add them up. And then, of course, all the overhead, you could add it up. Total costs of service rendered, $600,947. But now, auditing costs big bucks, too. Now, from here, we're going to go on to Chapter 3, which continues with overhead. We're going to back up and look at those problems that I assigned. So, Saith has his book, William. Maybe yours will be on its way or something. So instead of flipping pages in the book, we will look at a PowerPoint. Now this chapter will be dealing a whole lot with predetermined factory overhead rates, and we will also be dealing with getting rid of the under-applied overhead, what have you. But the first thing we're probably going to deal with, I can't find it. If you got a book, it's on page 70. It's on page 70. Now, if you don't have a book, I'm gonna try to find something similar on PowerPoint. Huh. Never had to unzip anything. All right, this chapter has predetermined overhead rates. We talked a little bit about that. We'll talk more about it. And then we've got flexible budgets and absorption and variable costing. Well, now absorption cost is what you've always done. All right, we'll look at the variable, which is the variable overhead and so forth, and the variable administrative. Okay, also flexible budget. But before we get to a flexible budget and predetermined overhead rate, I'm going to page 7. If I can find right here. All right. Now, mixed cost is called semi-variable cost. We know your power bill at home is mixed. You're going to have a bill fixed of about $30 whether you turn on a kilowatt hour or not. The rest of it's variable. And in the winter, your electric bill really varies. Telephone bills used to vary depending on how many long distance calls you make. You've come a long way in telephone. Your TV bill may still vary if you're in a lot of movies on demand or something like that. It could be semi-variable. You can separate that easy. But some semi-variable costs you can't separate. And you got to have a couple of formulas. They suggest a method of least squares. Have you ever heard of a method of least squares in any kind of class? It could have been mentioned in quantitative techniques. Now, what method you had here, Jessica? Quantitative?
Statistics.
I know, but you gotta have quantitative or something else, right? William, have you had quantitative?
I did last semester.
Well, I thought they might be taking it out,
We are taking it out.
so I don't have to take it.
No, but you'd have to take algebra 1.
Already took it.
If you had algebra, then you're in good shape. Remember that when we do your schedule. It's for the new catalog, but you can come under the new rules too, even an old catalog. But now, I don't know how the other professor taught quantitative techniques, but John Sneed taught it like a business math, and he agrees it needs to come out of there. And we lose a course in the School of Business, that's the only thing, we lose a course. But when I got a BS degree in anything, in business, you had to at least have put pre-calculus. And when I got an MBA, I had to have advanced calculus. Heck, I was not even good at pre-calculus. I definitely hadn't had calculus. But I got a tutor, and I studied as a Russian professor. He made mistakes and erased 3 blackboards. My first test, I got a 21. Scared me to death, but the highest was 28, and the 28 was an A. 21 was a B or C or something. But anyway, I got B's out of that course. In the public schools, because I passed advanced calculus, they certified me to teach math in the public schools. through 8th grade math, business math, bonehead math, and algebra 1. They didn't certify me to teach calculus. But anyhow, I think you need that algebra. I think you need certain maths. You may never use it, but it makes you think. Now, method of least squares. Have you had statistics? That didn't show up in statistics, did it?
I think it did at some point.
Could have showed up in statistics even. But anyway, we won't worry about it. Now, here is separating mixed cost. Now, here's what we're going to look at. All right, Y is total fixed cost, and A is the fixed portion, and B is the variable, and X is the activity base. So that's okay if you've got something to go on. We don't necessarily have to look at this formula, but it will help you doing this first method we're going to do. Now, the method we're going to do is called the high-low method, and that's this method. It's an easy method. We all can do it. We're not going to do regression analysis or least square.
Yeah, we definitely did this in Scouts.
Did you do regression analysis? Did you like that formula? I took a class and we had to prove something or another, research, and we were supposed to use computers. But there weren't computers at that time. You had to go to a big old room, big old card readers, card punchers, and so on. So I took my data and took regression analysis. And I took all the counties and towns in Virginia and money they spent on students and the dropout rates. And I proved there was a relationship between what money was spent on per student and dropout rates. And I did that for regression analysis. And the instructor liked it, so I didn't have to use computers. That's the only time I ever used it, and I wouldn't know how to work it right now. If you don't use some of these math skills, you lose them. But here's the one we're looking at, high-low. All right, you take the high and you take the low and you take the cost and you take the difference. All right, the difference is 44 and the dollars is 13.20. You get 13 cents a unit as your variable cost. And then you want to prove that. You can use that formula if you want to, but you don't have to. All right. We got to find the fixed cost here. They say it's 800, but how'd they get the 800? Now, what is 30 cents times 9,000? Take 30 cents times 9,000. What do you get? That's the variable. 30 cents times 9,000 is how much? How much?
27.
All right, 2,700. Then what is the total cost? Now the variable cost is 2,700 and the total cost is 35. So what is your fixed cost? So do you see where they got that 800? You can get that 800 without doing that formula is what I'm trying to say. Take the variable cost times your variable rate of 30 cents and get 2,700, difference is fixed. Let's try this one. What is 30 cents times 4,600 units?
$1,380.
1,000 what?
380.
All right, 1,380 Subtract that from 1,180.
800.
Now it's supposed to check on the high and the low. This being the high, this being the low. Now, you see how easy it is. So let me give you a problem in the book to play with. And William, I can't leave both up there, but now, William, I'm going to put this up there long enough for you and safe to get the numbers. So I got to leave that formula up there. I'll put the formula back right now. Let me show them the textbook. All right, this is the problem, folks. It's problem number 4, the high-low method. Wyoming Wholesale says gather the following data, blah, blah, blah. The number of shipments received and the cost received. Now, using the high-low method, develop the equation for predicting weekly. All I want you to do is find me the variable cost per unit and the fixed cost. Now, everybody look here and get your high. What is your high?
You step about 2 steps to the left.
You what?
You step 2 steps this way.
Yeah, what is your high then?
202.
At 60. 60 and 202, so jot that down, the high. What is your low? 35 at?
142.
All right. Now, skipping back to our formula then. What happened to it? Right there. Take it away. Find me the fixed cost and the variable cost.
You probably want slide 25.
The what?
You probably want 25 instead. 25 is the one with the numbers on it. That tells you how to do it.
Page, what, page 35?
No, slide 25. It's
Oh, you're
probably
looking
the one
right
you'd
here?
rather have up there.
Yeah. Okay, that's right. That's right. One other slide. Thank you, Jessica. That's one I thought I was bringing up. That,
Which slide you wanted.
yeah, that's what I want you to do, okay? Everybody find the fixed cost and the variable cost per unit. Okie doke then. Your high is what? How many units? 60? Alright, and the cost is
202.
dollars? And the low is 30 what?
5.
And the cost is?
142.
Alright, take your high and take your low. Now subtract Your low from your high in every situation. Here you'd get 25 units, and here you would get what?
60.
Is that $60? Now, if you divide the 25 into the 60, you get $2 and,
40 cents.
all right, now that would be your variable. Now, you don't have to use the formula at all. You know, we can take the 240 times 60 up here, multiply 240 times 60. What do you get? 240 times 60. What do you get? Anybody?
It's like 140 cents. I know the difference is 58.
The what?
So I know the difference is 58.
58?
Yeah.
Now what's that 58 called? Fixed cost. Let's see if it works down here. 35 times 240? 84? 84 from 44, does that also give you
58. 58.
58? Now, we know that 58 is our fixed cost. So, at any stage of production, hotel rentals, phone calls, whatever you're talking about, you can take the 58 fixed cost, and sure, that's plus uh, your variable cost was how much? 240. You can call that X, Y, or Z, or whatever you want. 240X. But we know X is the number of units. So it's 240 times 60. Or it's 58 plus 240 times 35. Or at any other stage of production or any other month. So, do you think that method's going to be okay? High-low method. Now, Jessica, I think you and Alexander had those in managerial. Okay. And you all have books. The two that haven't had it don't have books. So we got to get those books. Okay. Now that was the high-low. That's one concept I want you to get from this chapter. Now we'll get back to predetermined overhead in a minute, but I wanted to talk about budgets. You might do a budget for 5 days a week, 40 hours a day. You call that capacity. You might do a budget for 100,000 units. But what happens if we can only produce 90,000? Or what if we produce 110,000? That's where we need a flexible budget. Shows manufacturing overhead cost and behavior. Separates cost into fixed and variable. Provides budgeted cost for different activity levels. This is one I was talking about. Separate mixed costs into variable and fixed. We looked at the high-low method. Determine the A plus BX formula. A has been fixed cost. B was your high-low or anything in between, and X was your variable. Now here's a flexible budget. I don't think I can make that. Well, I can make it bigger, can't I? God. Different programs on this thing, you gotta do different things to enlarge. plus or a minus, or it's a magnifying glass. Okay, normal may be 50,000 hours. And you got budgeted for materials, labor, indirect labor, and that's all your variable overhead. Then you got your fixed overhead budget. Now that's for 50,000 machine hours. But what's happening down here at 40 or 45 or 55 or 75? What changes about these numbers? Nothing. Why? Why nothing?
Fixed.
Because it says fixed factory overhead. Now, divide 75,000 into 630. Take your calculators. Divide 75,000 into 630. All right. Now divide 40,000 into 630. Got those two numbers down. What are those numbers per unit? What you get per unit over here, William? 630 divided by 60.
630,
How much?
about 40.
Yeah, 630 divided by 40. I'm sorry, 40.
I got 15.75.
$15 and what?
75 cents.
Now over here, Faith, what'd you get? 630 divided by 75.
8.4. 8.4.
8.4. That's 840. Now, what economic concept does this illustrate? Economics of scale. The more you produce, the less your fixed cost per unit is. You make a bigger gross profit. Over here, 1575 and 840. Gosh, that's $7.35 different if I'm subtracting right. That's a lot of difference. Economics of scale. Your fixed cost per unit goes down. What happens to your variable cost per unit up here? Variable cost per unit stays the same, don't it? But fixed cost per unit goes down. Because fixed cost in a total stays the same. Variable cost in a total is different. Don't get that confused. Now, they showed you here at the bottom about this fixed cost. You know, you gotta cover your fixed cost. That's why you might take a slight loss to stay in business. If you can cover your fixed cost, just take a small loss. Some businesses, they close their door, they still got utilities, insurance, and so on. They still got some fixed costs. So we went from 775 to 14 to 12 to 11 to 8. Okay, this would be called normal capacity, I suppose. Huh. My pen will write down there, but it won't write up here. Anyway, that's normal capacity. All right, absorption costing is GAAP. We got our cost of goods sold, our selling expense, our administrative expense. We'll get down here somewhere and have plain old mid-income, but the absorption cost is what you've always done in principles of accounting. You've got sales minus cost of goods sold, gets gross profit minus your administrative and selling expenses. But over here, it's for internal use, and it's not necessary GAAP, and we've got to break down variable and fixed. So your variable costing, sometimes called direct costing, is just broke down between variable and fixed. Now on absorption costing, we have materials, labor, overhead. And we could break that down into fixed and variable. Variable costing, we have materials, labor, and variable overhead. We even get down into period cost, and we're going to break selling in general down into variable and fixed. All right, now look at this income statement with the absorption cost. You've seen that before, haven't you? You've seen this over and over. And under your cost of goods sold is your materials, labor, and overhead, fixed and variable. So you like to study that. You know it. But now here you take sales and you take out variable cost of goods sold and variable operating expenses, gives you contribution margin. Now, last semester you all learned this as revenue or sales minus variable cost is equal to contribution margin minus fixed cost is equal to net income. You remember that one, Jessica? That's all this is. We've already done this one too. But we've done absorption costs a lot. So here we're going to take sales, take out all variable cost, and you get contribution margin. Then you take out fixed cost, and you got net income. Income statement before taxes. You don't have to know these letters the way they have them. You do know these math symbols, I hope, though, in case you see them. So, in any math course, you should know what does this symbol mean in math? No, it's not mean equal to unless I put a line under it. Now, Jessica, it means less than or equal to. And this one just simply means AC is less than BC. I guess that's accumulated cost is less than variable cost. And of course, this symbol means more than. If you see it this way, it's more than or equal to. Some pages I have to blow it up and take it down. What two methods were used to separate fixed costs into variable and fixed? We did one. What was it? the high-low. The other one was regression or method least squares. What's the difference between variable and absorption costing? Your variable cost. You're gonna take it out first, and you get a contribution margin. How does underapplied overhead affect cost of goods sold and net income? We'll see when we go back and look at it. Now we'll practice these statements. Won't worry about the ethical issues right now, but we will get back to predetermined overhead rates, which is the first concept in the chapter. Now we know that we've done predetermined rates before. Might have done them in principle. We definitely did them in managerial. You take your budgeted overhead and some activity left. Here we use direct labor hours. But we can use direct labor what? We could use direct labor dollars, total cost. We could use machine hours. You can assign this predetermined overhead rate during the period, and you don't have to wait till the end to add up all your actual overhead. This one is common, and this one is common, and this one is common. These others are less common. Production volume, purchase orders, machine setups, material handling, those are less common. Alright, here we're using machine hours. So our overhead will be $7.50 per machine hour. That's variable overhead. Here's fixed overhead, $12.80 per machine hour. Now if we added these two together, this one and this one, and added these two together, it'd be $20.10 total overhead per hour. Okay, we worked 43,000 actual machine hours times 1260 gave us 54,000. Excuse me. How do you make a journal entry for its overhead applied? Excuse me. Now, we should keep a T account. We'll put our applied overhead over here, fixed and variable, and we'll put our actual overhead over here. Now, the difference between your debit and credit will be under, over, applied. And that was a question a minute ago. How do you dispose of that? We over applied $40,000. All right, read that carefully, what it's saying here. Read it carefully. If overhead is under applied, it's going to increase the cost of goods sold. That's what would happen. It would decrease that income, but you got to take care of that. If overhead is over applied, you got to decrease cost of goods sold and increase net income. If it's immaterial, you use this one account. If it's material, you use these three accounts. If work in process were 100,000, finished goods was 500,000, and cost of goods sold was 900,000. You'd have to add those up. You'll get 1,000,005. And what is 100,000 over 1,000,005? It'll be 1/15, wouldn't it? 500 over 1,000,005 would be a third. You'd have to get fractions to allocate that overhead difference. And there's a lot of capacity levels. I'd want to think normal we'd work with, practical, in theory, or expected. I wanted to show you what they were talking about with theoretical capacity. Everything's going perfect. You don't have any machine breakdown. You don't have any holiday downtime. All right? That's in theory. That never works. Practical is in theory, but you let holidays and downtime interrupt. Normal is what your historical production level has been. Expected is what the company anticipates you can do. And you determine that during the budget process. And that's where we got to separate mixed costs. Okay, folks, pretty much that is your chapter. I want you to read this chapter for Thursday. No problem assignments yet. I want you to get the problems assignments caught up from chapter 2. We need to have a test next Thursday, a week from this Thursday, on chapter 2 and 3. I'm putting that off to try to get, we'll say it's at this book, and if we even get his, we'll be okay. All right, with that, we're going to call it a day. Because my allergies are kicking in and my nose is starting to run.